What if the very instincts that make you smart in business or life are the same instincts that quietly sabotage your investments? Here's the tough truth. When markets roar higher, our emotions whisper, buy more. And when markets fall, those same emotions scream, get out. And that's exactly why so many intelligent Canadians end up buying high and selling low without even realizing it. With headlines shouting about record highs one week and looming recessions the next, it's never been easier to let emotions drive the wheel. In this video, I'm going to show you why our brains pull us in the wrong direction during both soaring rallies and scary downturns, and more importantly, how to protect yourself with a simple playbook built around automation, rebalancing rules, and calm pre-commitments. Whether you're 5 years out from retirement, already drawing CPP, or simply adding to your RRSP and TFSA each month, this approach helps you stay the course without second-guessing every headline. If you're new here, welcome. I'm Jacqueline Ozdemir, a financial advisor with Ferguson Financial Planning. Day to day, I sit across from Canadians who've worked hard, saved diligently, and yet still feel that tug of war between what the markets are saying and what their gut tells them to do. I've seen smart people get pulled off course by emotions, not because they lack discipline, but because the market has a way of testing even the steadiest nerves. And in today's video, I'm going to break down how to avoid that trap. We'll walk through the emotional cycle most investors unknowingly ride, the panic points that tempt us to sell when it hurts most, and then the practical solutions that put structure between you and your impulses. We'll also look at how to build a calm portfolio that you can actually stick to, plus an added focus on protecting income for those nearing retirement. If you find this video helpful, please remember to hit like, leave a comment, and subscribe so you don't miss future conversations like this one. All right, let's dive in. Let's start with the big picture, the market cycle of investor emotions. Now, if you've ever seen this chart, it looks like a roller coaster. It begins with optimism, climbs through excitement, peaks around euphoria, and then slides down into anxiety, fear, and eventually despair, before it bottoms out at capitulation, then quietly rebuilds with hope and optimism again. It's uncanny how well it matches real behavior during market swings. Here's the thing. Most investors think they're making rational decisions, but the truth is that we move with the crowd far more than we realize. At the euphoric top, we feel invincible. We read about friends doubling their money or seeing stocks climbing week after week, and the fear of missing out becomes irresistible. But that's actually the point of maximum risk. Because everything feels so good, many of us buy at inflated prices, set up perfectly to be disappointed when markets come down. On the flip side, when things look the darkest, that's usually when opportunity is at its greatest. In despair, when headlines scream about recessions, layoffs, or the worst market in decades, that's historically been the point of maximum opportunity. But guess what we do? We sell. We hit the eject button because loss aversion, the psychological phenomenon where losses feel about twice as painful as gains feel good, kicks in hard. Here's a quick case study. During the global financial crisis in 2008, an investor with $1 million in a balanced portfolio saw their account drop by roughly $200,000 in less than a year. If they had panicked and sold in March 2009, they locked in that loss. But investors who stuck with their plan saw markets not only recover, but more than double over the next decade. The difference between staying the course and hitting eject was quite literally an extra $1 million in long-term wealth. So why does this matter? Well, unless we train ourselves to anticipate our own reactions, we will repeat the cycle again and again, buying high and selling low. That's why I want you to view this emotion cycle like a map. If you're feeling elated, odds are the risk is higher than it feels. If you're feeling despondent, odds are opportunity is greater than it appears. Your edge isn't market timing, it's self-awareness. Now, let's zero in on long bull markets. These are stretches of time when markets have gone up steadily for years without a major correction. Feels good, right? Returns are compounding, your statements look fantastic, and suddenly risk feels optional. This is when recency bias and FOMO, fear of missing out, tend to creep in. Here's how it plays out. Imagine you've set your portfolio to be 60% equities and 40% fixed income. After a 5-year run without a significant downturn, the equity grows so much that it balloons to 60, 70, or even 80% of your total portfolio. On paper, that looks great. But in reality, your portfolio has drifted well outside your personal risk tolerance. If you don't rebalance, you're unintentionally taking more risk than you thought you were. Let me give you a story. Dave, who was 59, was planning to retire in about 3 years. His original plan was a conservative mix with a chunk of fixed income to protect against market swings, but after a decade, he felt like he was missing out. Articles were everywhere about stocks only go up, and his peers were talking about double-digit growth, so he shifted more of his safe allocation into equities. Unfortunately, the market corrected soon after, and Dave saw his account drop sharply. Suddenly, instead of cruising into retirement, his plan fell into jeopardy. What turned things around for Dave wasn't guessing when the market would recover, but instead setting rules. He capped his equity exposure at a maximum and created narrow rebalancing bands. Plus, he moved 1 year of withdrawals into a GIC-type holding, so he knew his near-term cash was safe. Instantly, his anxiety lifted because he had a plan to protect his short-term needs and let the rest ride out the recovery. And that's the lesson. When times are good and the news is sunny, resist the urge to throw your safety net out the window. Set a maximum equity cap. If you feel the itch to increase risk, apply a waiting rule. Wait perhaps 3 months before acting. Often that cooling off period is exactly what you need to let your rational brain catch up to your emotional one. Now let's shift to the other side of the cycle, the downturns. Those painful corrections or bear markets where it feels like every day your statement bleeds red. And when markets are down 20%, that amplified pain drives people to cash out. But here's the kicker. Selling turns a temporary loss into a permanent one. Historically, Canadian and US markets recover from corrections in about 1 to 2 years on average, though bear markets could take longer. Decades of data show that those who stayed invested came out ahead. Those who sold at the bottom often did not reinvest until after markets recovered, missing the rebound entirely. Let's talk about Maya, a 45-year-old professional. During a swift downturn, she decided to pause her RRSP and TFSA contributions. Her thinking was, why throw good money after bad? I'll wait until things stabilize. A year later, markets had rebounded, and she looked back, realizing that she had missed buying assets at a 20% discount. Had she continued contributing $1,000 per month during the downturn, she could have built an extra $10,000 or $15,000 worth of holdings at sale prices. These are assets that would grow even more through recovery. By stepping aside until the coast was clear, Maya cost herself meaningful future growth. The simple remedy? Create a pre-commitment rule to keep contributions flowing, rain or shine. Some investors I work with even create a rule that if markets are down 20%, they will pull forward an extra contribution if the cash is available. The key is commit while calm, so you don't have to negotiate with yourself when stress is high. Now let's talk about the remedy. If emotions pull us in the wrong direction, then structure is the antidote. And in practice, structure looks like automation, pre-commitments, and rebalancing. Let's break that down. Automation means setting your RRSP or TFSA contributions to flow monthly like clockwork. It removes the question, should I invest this month? Because the answer is yes. It lowers decision fatigue and evens the ride. You buy more units when prices are low and fewer when they are high, smoothing your average cost over time. Next, you'll want to think of rebalancing as a thermostat. If your equity exposure drifts too high above the target, you sell a little and add to fixed income. If markets tank and equities drop below your target, you buy more of them, effectively selling high and buying low, but automatically and without drama. Now, how do you set rebalancing rules you'll actually follow? One option is tight bands, say plus or minus 5%. This forces frequent but small corrections, perfect for folks who like to stay engaged. The other option is the 50-25 rule, where you rebalance an asset if it drifts either 5% of portfolio weight or 25% of its allocation. So if Canadian equities were targeted at 10%, you'd rebalance if they slid below 7.5% or rose above 12.5%. This approach is less fussy and it suits people who prefer to set it and forget it. Finally, pre-commitments. This is about deciding in advance how you'll respond to swings. Write it down. If markets fall 10%, you'll keep contributions flowing and check bands. If they fall 20%, you'll rebalance and maybe add an extra contribution. If equities drift high, you'll sell back to target. Once the rule lives on paper, your brain no longer has to negotiate when emotions are high. Now, let's talk about building what I call the calm portfolio. This refers to building a diversified mix of equities, bonds, and a reasonable cash buffer, anchored by clear rules rather than chasing the latest stock tip or headline. Here's why this matters. If your portfolio is too aggressive, then every downturn feels catastrophic, and you might not stick with it. If it's too conservative, you'll sit on too much cash and miss the long-term growth that equities almost universally deliver. A calm portfolio strikes the middle ground. It's resilient in storms and is satisfying in good times. It's something you can actually live with. A great tool I've seen for this is an investment policy statement or an IPS. Don't let the name scare you. It's just a one-page document that says, here are my goals, here's my maximum and minimum risk levels, here's my new rebalancing rule, here's when and how I'll contribute, and here's my panic plan. The panic plan can be as simple as, if the market falls 50%, I will do these 3 things. Keep contributions on, rebalance once, and not read headlines for 2 days. Write it down. It is powerful. When fear strikes, you've got a calm day version of yourself guiding you. I worked with Owen and Leanne, married and in their early 50s, who found themselves ping-ponging their decisions with every headline. One news article said recession, another said boom. They could not sleep and were trading out of fear. We put together a one-page IPS, set rebalancing rules using the 5-25 method, and established a 2-year cash flow buffer since they were approaching early retirement. The result? They stopped overtrading, their sense of calm went up, and the headlines lost their power. That portfolio became something they could live with because their plan gave them a certainty in uncertainty. Finally, we need to talk about people approaching retirement. The 5 years before and after retirement are fragile because of something called sequence of returns risk. If markets take a deep dive in your first years of retirement, withdrawals from a depressed portfolio can permanently alter your wealth trajectory. The emotional side of that risk is even stronger. Imagine seeing markets drop just as you stop drawing a paycheck. Suddenly, fear kicks in. Overdrive. You might feel you have to sell or drastically change your plan. But panic-driven changes at that point can have lasting negative effects. The solution many Canadian retirees use is keeping 1 to 2 years worth of planned withdrawals in cash or near cash instruments like GICs, high-interest savings, or short-term bond funds. If the market drops 20%, you know you can cover expenses for the next year or two without touching equities, giving your investment side the breathing room it needs to recover. Dave, the near retiree, did exactly this. He moved 1 year of expected expenses into a high-interest savings account inside his RRSP. That meant when volatility struck, his day-to-day life wasn't rattled. Better yet, he could let the rest of his portfolio ride the recovery without fear. That single step turned what felt like a panic situation into a manageable one. And here's the truth. Retirement isn't just a math equation. It's psychological. Protecting a runway buys peace of mind, but more importantly, it reinforces discipline. You're not forced to pull money out of equities at fire sale prices. Instead, you're calm, covered, and content to let the cycle do its thing. So whether you're 15 years from retirement or 5 months, consider this runway. It doesn't have to be exact to the penny. It's about creating confidence in your plan. When confidence is high, discipline follows. And discipline is what separates investors who accumulate wealth steadily from those who let emotions erode their hard work. At the end of the day, you don't need a crystal ball. You don't need to outguess markets. What you need are rules you'll actually follow. And once you do, the market cycles stop feeling like a roller coaster and start feeling like a ride you're willing to stay on. So let's step back for a second. We've seen how the market cycle of emotions tricks us. Euphoria makes us reckless. Despair makes us panic, and both pull us away from good decisions. We've looked at real outcomes. Investors who stayed disciplined through downturns ended up with hundreds of thousands, sometimes even millions more than those who sold at the wrong time. And we've covered the toolkit to break this cycle: automation, rebalancing, pre-commitments, and building what we called a calm portfolio. Here's why this matters. Without structure, emotions will win. And over decades, that can mean giving away a lifetime of growth. But with structure, you tilt the odds back in your favor. Instead of dreading downturns, you treat them as sales. Instead of chasing rallies, you stick to your rules. If you're preparing for retirement, small steps like holding 1 or 2 years of income in cash can transform panic into quiet confidence. It's not about predicting the next headline. It's about having a plan strong enough to drown the noise. Rules win, discipline compounds. And that's how wealth is truly built. So here's the bottom line. If your portfolio feels like a roller coaster right now, the answer usually isn't chasing better returns. It's building rules that help you stay calm through the ride. And the thing is, those rules will look a little different for everyone, depending on timelines, risk comfort, and cash flow needs. Now, I'd love to hear from you. What's been your toughest moment as an investor? Was it selling too soon or being tempted to stretch your risk when markets were hot? Drop your story in the comments. I read every single one, and your experience might help someone else too. And if you'd like to see how these strategies could fit your own situation, click the link in the description to book a discovery call. We'll talk through your goals and map out a structure that makes sense for you. Finally, if this video sparked a few ideas for you, hit subscribe and turn on notifications so you catch the next one. Thanks for tuning in today. I'm glad we got to have this conversation, and I'll see you in the next video.